All right, so if you're a US citizen living overseas, you've probably got the whole I still have to file US taxes thing down. But what if I told you that the most popular go-to strategy for expats might actually be a trap? A trap that could be costing you thousands of dollars in cold hard cash every single year. Yeah, let's dig into this and figure out the right financial path for you.
So here's what we're going to cover. First, we'll look at the big problem, the global tax net that catches every single one of us. Then, we'll talk about that famous $130,000 exclusion everyone knows about. After that, we get to the real meat of it, the FIEE versus the foreign tax credit. And trust me, this is where it gets interesting, especially if you've got kids. We'll even hit on some critical reporting you can't forget before tying it all together into a solid strategy.
Okay, first things first, we gotta lay the groundwork. Let's talk about the one fundamental rule that makes this whole conversation necessary. And honestly, it's something that completely blindsides a lot of Americans when they first pack their bags and move abroad.
I mean, it makes perfect sense, right? You live abroad, you work for a foreign company. Why on earth would you owe Uncle Sam a dime? It seems logical. But for Americans, the answer is, well, it's not what you'd expect.
And boom, here's the core of the issue. The US government taxes its citizens and green card holders on their worldwide income. It doesn't matter where you live. London, Dubai, Tokyo, doesn't matter. Your salary, that side hustle, your investments, it's all on the IRS's radar. This whole thing is called citizenship-based taxation. And believe it or not, the US is one of only 2 countries in the entire world that does this. The other one? Eritrea. Yeah, strange company to keep. And look at these numbers. This is what's really wild. For the 2025 tax year, if you're single, you only have to make $15,750 worldwide to be required to file. And get this, if you're self-employed, maybe doing some freelance work, that number drops to just $400. $400. Pretty much any expat with a job is going to blow past these thresholds, which means filing isn't a choice, it's a requirement. Okay, so if you have to report everything, how do you keep from getting taxed into oblivion by both your host country and the US? Well, this brings us to the most famous tool in the expat's toolbox, the Foreign Earned Income Exclusion, or as everyone calls it, the FEIE. And there it is, the big number for 2025, $130,000. It's a huge number, right? It's so powerful because it lets you just poof, erase a massive chunk of your income from your US tax return. On the surface, it looks like the perfect solution, the magic bullet for pretty much every expat. So just to be clear, what this means is you can literally subtract up to $130,000 of what you earned abroad from your US taxable income. And if you and your spouse are both working overseas, you can potentially double that to $260,000 combined. It's easy to see why this is the default move for so many people.
Now, you can't just claim it, you have to qualify. And there are 2 ways to do it. First is the bona fide residence test. This basically means you're a legitimate actual resident of a foreign country for a whole uninterrupted tax year. The other one is the physical presence test, which is just a numbers game. You just have to be physically outside the US for at least 330 full days in any 12-month stretch. Most expats easily fit into one of these 2 boxes. Okay, so you use the FEI, your US tax bill goes to 0, problem solved, we're done here, right? Well, not so fast. This is where things get really interesting. This is where we move from just filing taxes to real strategy. Because there's another player in the game, the foreign tax credit. And picking between these 2 can have absolutely massive consequences for your wallet. So here's the breakdown, the head-to-head matchup. The FIE, as we said, just erases income from your return. But the foreign tax credit, the FTC, works totally differently. It doesn't care about your income. Instead, it gives you a dollar-for-dollar credit against your US tax bill for the taxes you've already paid to another country. So, let's say you paid 10 grand in taxes in the UK, you get a 10 grand credit on your US return. Simple.
This makes it a no-brainer for folks in high-tax places like Germany or Canada, but check out that key limitation on the FIEE side. It can block certain refundable credits. And right there, that's the drop. And for anyone out there with kids, this next part is absolutely crucial. This isn't just some tiny detail buried in the tax code. We're talking about a complete game changer. This is what determines whether you just owe zero or whether you actually get a big fat check from the IRS. $1,700. That's the number you need to remember. For 2025, that's how much of the child tax credit is refundable per kid. Now, refundable is the magic word here. It means the IRS will literally send you a check for this amount, even if your US tax bill is already zero. So you've got 2 kids, that's potentially $3,400 coming your way. Cash. And here's the catch. The fine print. This is straight from the horse's mouth, IRS Publication 54. It says, flat out, if you choose the Foreign Earned Income Exclusion, you can't take the refundable part of the child tax credit, period. This is the hidden trap that so many people fall into. You're forced to pick one. You can't have both.
Let's make this real. Look at these 2 families. You got a family in Dubai where there's no income tax. For them, the FEIE makes total sense. They don't have any foreign taxes to claim as a credit, so excluding their income is the way to go. But now look at the family in Germany, a high-tax country. They can use the foreign tax credit. The taxes they paid in Germany completely wipe out their US tax liability. Their US bill is zero. But because they didn't use the FEIE, they're still eligible for that $1,700 per child refund. So both families owe zero US tax, but the family in Germany is thousands of dollars richer. That's the difference.
So let's just bottom line this. If you live somewhere with a decent income tax, think Europe, Canada, Australia, and you have qualifying kids, choosing the FEIE is very likely the wrong move. You're literally just leaving free money on the table. You're telling the IRS, no thanks, you can keep it. All right, so we've covered the big strategy piece, the FEIE versus the FTC. But there's another layer of compliance that's just as important. These aren't choices, they're must-dos, and the stakes for getting them wrong are incredibly high. And the big one you have to know about is the FBAR, the Foreign Bank Account Report. And here's what's key. This is not a tax form. It doesn't go to the IRS. It goes to a totally different part of the Treasury Department, the part that fights financial crimes. It's all about disclosure, not taxes. And here's the trigger. $10,000. If the total of all your foreign accounts, we're talking checking, savings, investment accounts, all of them, if that total hits 10 grand at any point during the year, even for one afternoon, you have to file an FBAR. It's a simple, hard rule. And this is the crazy paradox of being an expat filer. You can do everything right, use the FTC, owe $0 in US tax, get a refund even. But if you forget to file this one separate non-tax form, the penalties can be absolutely devastating. We're talking tens of thousands of dollars. It's no joke. That's why you can't afford to miss this. Okay, so let's pull all these threads together. What this all boils down to is that for expats, the goal isn't just to get your taxes filed, it's about filing the smartest return for your unique situation. All right, so let's run through the key takeaways one more time. 1. The US taxes your worldwide income, no escaping it. 2. The FEIE is powerful, but it's a trap for families because it blocks that refundable child tax credit. 3. The foreign tax credit is your best friend in high-tax countries. It can get you to a zero tax bill and unlock thousands in refunds. 4. Be careful. If you switch off the FEIE, you can't just switch it back on next year. You're locked out for 5 years without special permission. And finally, whatever you do not forget to file your FBAR. So I'll leave you with this one question to think about. When it comes to your US taxes, are you just being a taxpayer, just trying to get it done and meet the deadline?
Or are you being a strategist, making the smart choices that actually improve your family's bottom line? Because as we've seen, the difference between those two approaches isn't just a few bucks. It could be thousands of dollars year after year.